Welcome to the Wise Fiduciary Podcast. I'm Marta Hurst. If you're a plan sponsor, committee member, advisor, or an executive responsible for a retirement plan, this show is for you. Season 5, we're doing something different. This is about the fiduciary red line. It's where industry standard stops being safe and where a routine decision quietly becomes exposure. Each episode, we take one decision point and examine it closely, not from a sales perspective or marketing perspective, but from a fiduciary one. Because most plan failures don't begin with bad intentions, they begin with comfort. So let's define the red line. Every plan has a QDIA. If they don't, they should. And for many committees, checking that box feels like a one and done. But here's the truth I want to focus on today. Choosing a QDIA doesn't complete your fiduciary responsibility. It's ongoing, like so many of these fiduciary things are. So today we're going to talk about the ongoing monitoring of default investments, evaluating glide paths, things to know, because when it comes to defaults, thoughtful diligence protects participants and it protects you. Joining me today is my friend, colleague from another company. We have done some travel together. We've worked on some projects together. Bryce Sowitch. Bryce has held various positions serving and consulting on retirement plans over the course of his career. Welcome, Bryce.
Thank you. Glad to be here.
Bryce, can you give us a little background on you and how you ended up becoming an expert on retirement plan investments?
Yeah, absolutely. I mean, really, it's just 30 years of working with thousands of plans and hundreds of committees over those years. And, you know, what you realize is that retirement plans, and especially things that are this deep like QDIA, are probably number 10 or 11 on most people's priority list. So bringing those kind of the forefront and really addressing what needs to be done within the retirement plan so you can do your due diligence, I think is very important. I've worked with providers a long time ago, worked with as an advisor, worked as a 338 discretionary investment fiduciary. Currently, I co-run the Retirement Solutions Group at Focus Partners Wealth. We have about 3,200 retirement plans under advisement, both from an advisory capacity and 338.
Wow. Well, and I know you guys have had a lot of acquisitions over the last couple of years. So that's quite a book of business you've got now to be responsible for. So let's start with the basics for our listeners. What is the QDIA? So as a reminder, it's the investment that participants land in when they don't make a choice. So maybe there's a profit sharing contribution. They're not making their own contributions, but they receive some kind of employer contribution. So there's no election on file for them. Or now I feel like a lot of these online enrollment processes through record keepers are just like, hey, do you want to just stay in the QDIA? And really by the investment, most participants end up staying in because they don't go out and make changes. I feel like this is kind of an older stat, but I remember when I was doing enrollment meetings in my early 401k days, there was something like 70% of plan participants don't make changes to their accounts after they enroll. Do you think that's still valid?
I think it's valid, absolutely. And inertia, if priority list for plan sponsors, this is number 9 or 10, it's probably 28 or 29 for participants, most participants. Not only do they not like making these types of decisions, but they don't want to revisit it very often. And we hear a lot of times we need more tools in the industry. I don't think that's the case. I think the more we can make it streamlined and automatic, the better off we are, because people do not make changes once they make those original elections in their plans.
So I think some questions for the audience to consider, especially if they are helping run a retirement plan, are, do you know how many participants are in your QDIA right now? And do you know why it was chosen for the plan, or did you inherit it? So our red line for today, choosing the QDIA is not the end of oversight. selecting does not equal protection. So, Bryce, when you meet with committees, what do you see is the biggest misunderstanding about what the QDIA actually is?
Well, I don't even think choosing the QDIA is the endpoint. I think there's things that come before that. The first thing, which hardly anybody realizes, is you do have to base it on the demographics of your plan and the people in your plan. And that's very difficult to do because if you have a company with 200 employees, they're all different. So how do you say you have one demographic, and how do you customize what you're doing in the QDIA space? So I think the biggest misunderstanding is we just look at the best performing target date funds, which can actually get you in trouble. If we go back now a couple decades, I mean, target date funds have been around for, I think, 25 years now. But if we go back 15, 20 years, we had a market run up. And what we saw inside some target date funds, I won't name names, but the retirement funds had 80% in equities. So if you're looking at performance for your decision-making process only, I think you really fall into a trap of chasing performance. And when those go poorly and the market performs poorly, it really exposes where you are. But I think the biggest misconception is that they're unsophisticated vehicles, that they're just for people that aren't paying attention. And my comment to that typically is, well, I guess I'm one of those people, because the benefit of target date funds is not only does it get you allocated correctly, changes over time, but it removes you behaviorally from managing your money. And even people in the money management business should have that benefit. They should not manage their own money. I'm a true believer in that. So the biggest misconception, I think, is that they're just for people that aren't sophisticated investors. It's absolutely not true. These tools have come a very long way, and there's some innovations on the horizon that will make them even more sophisticated.
So you talked a little bit about knowing your demographic and needing to understand that in order to decide what kind of QDIA. What does appropriateness really mean when we're talking about QDIA suitability for a specific workforce?
I think when you're looking at a specific workforce, we talk about the typical things. What does the glide path look like? How quickly does it become more conservative? But it goes deeper than that. The investments in certain providers' target date funds change when they get closer to retirement. They have different philosophies on withdrawal rates. So really, when you're looking at your demographics, I think a question to ask is, what is the tenure of my employees? How long are they here? Because if we're planning for people that won't even be using this product in retirement, that is a problem. So how long are they there? If they stay, or if they leave their money in the plan, if you've done a good job and you make it attractive, they'll leave their money there when they leave. Now you're still responsible for them, but what does their withdrawal methods look like in retirement? What are their habits? Those types of things. And that's just incredibly difficult because the average household doesn't even have a budget today. So their spending patterns are all over the place. They're very different for everybody. And finding solutions to that is a real challenge, which is why you find things like lifetime income being talked about more and more, things like private investments inside 401k plans. But the challenge really with appropriateness is, how are they going to use the product? The fact of the matter is, your typical employee at a company is going to be there a smaller and a smaller amount of time. We've seen that over the last couple of generations. So what are you doing? Are you managing it for today? Or are you managing it for them in retirement? Are you trying to get them to retirement? So it's a very, very difficult task. And to make it even more difficult, target date funds are set with their glide path. They're typically set with their investments. They change the allocation over time. But one size fits all is kind of the better of two evils, really. If you look at asset allocation funds, which really were around a long time before target date funds, those are probably a better fit from an investment standpoint, from a customizable standpoint. But what we've seen is behavior trumps all. And the huge adoption of target date funds, I think, really has proved that out. So now we're seeing target date funds that are trying to blend the two. You have target date funds that have multiple glide paths. You have target date funds that start to implement income options later in somebody's career. But planning for everybody is very difficult, because when I say the demographic at Fiduciary Wise, and then you look around at everybody at Fiduciary Wise, everybody's different. They spend different, they save differently. They're different ages. They work different amounts of time. So they retire at different times. So that's a challenge. So I think you have to plan for the masses, for the largest group that you have. Don't fall into the performance trap. Look at expenses, and make sure that you have quality target date funds, because really the benefit of them, the biggest benefit of them, in my opinion, is the behavioral changes that it causes in people. It's not necessarily the outputs of those target date funds. But Department of Labor tells us that we do have to look at demographics when deciding if it's appropriate or not.
Okay, so you have already mentioned that we need to be looking beyond performance. We're not supposed to be picking target dates just based on how they have typically performed. We talked a little bit about the starting point for selecting a QDIA, but what does ongoing monitoring look like? And I think you talked about that a little bit and how things can change over time. Anything else you want to add there?
Yeah, ongoing monitoring. I think backing up just a little bit, you also have to decide, do you want to index within the target date funds? Do you want to actively manage? Because the ongoing monitoring is very different for the two. If you have active managers, now you have to start looking at things like manager tenure, their experience, their performance. If a manager leaves, is that an issue or not? You have to look at dynamic target date funds where the glide path may be different over time and change at a different rate than others do. So I think really those decision points, the demographics first, then you want to look at, do you want to index? Do you want to use active management? If you use active management, then you have to start looking at the management team and decide how well they do. And one of the challenges in target date funds is typically these are provided by record keepers, and the funds in the lineups are proprietary. They're all their funds. Mm-hmm. And I always like to compare it to Major League Baseball and the All-Star team. We can't have the All-Star team if we have the Colorado Rockies, right? We have the Colorado Rockies, and that's typically what you're getting with a typical target date fund. Now, there are ways that you can get around that. There are certain collective trusts out there that will put best-in-class managers in place. But as you start to dig into it, you start to see there's a lot more to it than just looking at the output, which is performance.
All right. I think that's pretty fair. Can we talk about the glide path a little bit for committees that don't live in the investment world every day? What's the simplest way to think about a glide path?
The simplest way to think about a glide path and to visualize it is an airplane landing. And when you're at 35,000 feet, you have a long time before you land, right? And the same thing is true with target date funds. You have a long time until you retire. So maybe the year 2065, that's the fund you're going to pick when you're very young. Now, as time goes on, those funds are automatically going to get more conservative. They're going to start protecting your money. They're going to have more bonds. They're going to have more cash in the allocation. But the glide path is simply the rate at which the funds become more conservative over time, typically in 5-year increments. And they really come in two flavors. They come those that are managed to retirement. If they're managed to retirement, that means they're managed until age 65, and then they don't change. Typically, what we'll see is something like a 40% stock allocation at that point, 60% bond allocation. Now, through retirement, and this goes back to your demographics, is the money staying there after these individuals retire or not? So if they are, maybe you want to have a through retirement type allocation. A through retirement really is, retirement is a point in time. It's along the glide path. It's maybe at 10,000 feet. You're not landing yet. Your landing point is actual life expectancy. So you're coming in for landing, but you're not landing yet. And that is something that is very hard for participants to grab onto. Everybody sees it as the end point. Retirement's the end point. It's not. It's just a point along the continuum. So if you have a lot of people that keep their money in the plan, and this only comes from experience, a new plan can't know this. They don't know this. Are people going to leave money in the plan after they retire or not? And I think there's a philosophical part of it. Does the committee think that their job is to get people to retirement, or is it really to help them through their life, including through retirement?
All right. And interesting. What are most of your clients like? Or is it, I mean, you got a lot of clients now, so.
Most are to retirement. And, I would say that until the retirement plan industry is more innovative with products and solutions for actually using the money, to retirement, I think makes the most sense. In a lot of cases, most people are going to leave. They're going to probably roll their money to an individual retirement account. They're going to have more options for investments. Maybe they do want lifetime income, but they get it through an individual annuity, something like that. But most of the time, what we have seen with our plans is to retirement.
Well, and I was just thinking about some of our clientele, and most of them, they don't want participants still in the plan after they retire, because then they've got to keep track of those snowbirds and wherever they end up and travel to or move. And then you're still burdened with making sure that they get all the appropriate disclosures and everything. So I can think of some clients that would be like, no, we don't want to do that through. We don't want people to stay any longer than they have to. But I do have we do have a few clients that typically maybe more on the 403B side, that they want people to have a spot to stay, and they don't want to kick people out of a plan, even if they do have low balances. So I was trying to figure out, are there people who are in that category? But yeah, I can actually think of a few who do. They just end up having a lot of retired people in their plan. Yeah. So in your experience, what are the red flags that a QDIA, in your experience, what are the red flags that a QDIA is no longer aligned with a plan's participant population?
That's a good question. I think typically what we see when there's a target date switch on a plan that may be new to us, we've inherited the target date space, and we've asked, how did you make this decision? And the answer is, maybe it was the advisor's favorite provider or something like that, or we got a record-keeping discount for using it. Those are typical answers that we get. But if we look at it and the allocation is very aggressive or very conservative, those can be equally damaging. So we do want a reasonable performing target date series. It's not going to be the best during every period, nor does it have to be, because like I said earlier, the biggest benefit is those behavioral changes. And then do we want to take advantage of the indexing safe harbor within the target date space? There's certainly arguments to be made both ways. Do you want to use a blend? There's wonderful compromises you can make. You can index the stock version of the portfolio, and you can actively manage the fixed income, which the managers can add alpha. They can add some excess return there. So those are questions that typically a plan committee hasn't been asked. How do they feel about it? What do they think? And if you ask them on the surface, they won't know the answer. And I think this is a more than one meeting decision, because they need time to think about it. They need time to look at maybe some data, what their experience has been. But I typically like to use funds that have various managers within them. If they don't, then I want to use an index version of it, because, like I said, the Colorado Rockies can't compete with the All-Star team. So we want the All-Star team when we can get it. And I think there are some innovations happening. There is a version that has best-in-class managers in each category that's been around for probably about 15 years now that you can access. So to me, that's the biggest red flag as a manager, a target date series that has all one fund family in it if it's actively managed, because there's not a fund family out there that is good at international, domestic equities, bonds. So it's very difficult to find. But typically it's an inherited type situation where we'll make a change.
So you're a 338 investment fiduciary for a lot, maybe all of your clients. I don't know. Are you? I assume you're having these kind of conversations with them. So even though they might have some input, ultimately, then that comes back to you. Do you? But I guess I'm also just kind of thinking about how this comes about. I mean, you're taking into consideration their input about their demographics, about what they want for their plan. Am I following that line of thought?
Yeah. I mean, we operate as 321 or 338. It depends on the situation. And you're right. A lot of 338 services, you'll have one lineup, you have to take it. And if that's the case, well, there is no qualification going into the QDIA space. So we do have multiple versions. We have active, we have indexed, different glide paths, those types of things. So we can take into consideration that specific client and what their needs are.
Okay, I gotcha. What is one thing every committee should do? Nope. What is one thing every committee should start doing before their next QDIA review?
I think there's a couple things. Number one is Google Department of Labor target date guidance. Just read through it. It's been out for a while. I think it was 2013 where they issued it, but just read through what they say about it, because a committee, if we're looking at this from a committee perspective, we really have a couple goals. Number one is to protect them as fiduciaries, but our overarching goal is results for the participants and their beneficiaries. So read through their tips, and you can find these online, a checklist, an education piece on what target date funds actually are, because they are not all the same. In fact, even if you're making your decision based on performance, a very difficult thing is comparing target date funds to an index. There's not an index. You have to match together a bunch of indexes to get there. And the problem is that every 2045 fund out there probably has somewhat of a different allocation to stocks, bonds, and cash. So now your index doesn't match those things, right? So right. We've seen situations where the 2035 fund is equal to another manager's 2045 fund from an allocation standpoint. So I think educating yourselves first on what it is and why it is. If we back up, I've been doing this long enough. I remember when cash was the default, and what a disaster that is. 30, 40 years.
Terrible.
Yeah, terrible. So there's still plans out there that have that in their plans. We still run across those from time to time. But I think educating yourself is about what QDIA actually is and what it does for you. And then number two is, what are the actual benefits of it? There are practical benefits. And I'll say it again, the biggest one is the behavioral change in participants, in the fact that they stay invested. It is the stickiest. You talk about inertia. You talked about it earlier. People don't change their elections. This is an environment where they're fine to do that. In fact, they're probably the most successful investors because they don't look at it. They don't make changes to it. And over time, it grows. And over time, it changes to a more appropriate allocation for them.
I think that's a really good point about the participant behavior, because I remember in my early days, I also was licensed. So sometimes I would take participant questions, and when the market does bad, everybody bails, and then they don't know, then what? When do I get back in, and how do I decide? And did they get out at the right time? Probably not. They probably got out too late. They're probably getting back in too late. And so having something where you can, and maybe should, just sit it and forget it. I was thinking, while I was getting ready for this episode, what am I invested in? I'm pretty sure it's a target date. And when is the last time I looked at it? I don't know. I just like to look at my balance occasionally and make sure it's still going up, but I haven't thought about what I was going to invest in a while. I mean, I tried to do some fun stuff at one point in my life, but now I'm like, no, I'm too busy for that. And I think, you mentioned a lot of people think that this is like for the unsophisticated investor, but it's also like just like from a fiduciary wise standpoint, what we talk about. Do you have the time to allocate to doing this? No, don't want to. I don't want to. So a lot of participants, end up in the target dates, and that's not bad. And I have run across people who think that's bad, and I think it's great for all the reasons you just mentioned. Yeah.
Do you have the time? Do you have the discipline? And do you have the ability to separate your emotions from the decision-making process?
No.
I'll give you two really quick examples. COVID in 2020, March of 2020, market went down significantly, most volatile month in market history. And target date investors, it wasn't 100%, but it was upper 90s, stayed invested. The market was back to even within 3 months. If we look at the tariff announcement last April, same thing. Market went down significantly, came back within 6 weeks, and target date investors stayed invested. Now, those participants that I talk to that call me and say, hey, when this happened, and we have recent examples, Iran, for example, said, I got out of the market, oil's going to $100, $105 a barrel. I'm going to get out, wait for it to get better. And those folks will get back in probably too late. You have to be right twice. Yeah. And that's the biggest challenge. The best thing to do is give what the market gives you. There was a great study done, this is probably 15 years ago now, but MFS did it. And they looked at people that manage their own money and people that had it managed for them, meaning in target date funds, asset allocation funds, things like that. And they found that participants managing their money themselves got about half of the return. In all of it, every single bit of it was behavioral. So you're talking about 5% a year in return they're giving up just from their behavior.
I believe it. I'll tell you, when I quit managing my own, like trying to do the guesswork and stuff, is when I went to lunch with an advisor, and he was talking about how great he was at predicting the market and what he thought was going to happen with the market. And I made a move based off of that. And it wasn't bad, but it wasn't good. To your point, like I did everything in the wrong time. So anyway, well, thank you for joining us, Bryce. I have been giving our listeners some homework items to consider. So
look, she remembers. Remembers what?
Here's the homework for this week. Pull your QDIA review documentation. Hopefully you have some. Look at the glide path, look at the fees, and look at how it fits your workforce today, not 5 years ago. And hopefully that gives you some things to think about. So thank you, Bryce, for joining today. If today's episode raised questions about your plan, that's the point. Fiduciary responsibility is not about checking boxes. It's about understanding where the red line actually is. If you want to continue the conversation, please follow our social media for ongoing insights and commentary. If you need clarity around your own plan decisions, schedule time with our team at fiduciarywise.com/scheduling. And until next time, stay thoughtful, stay disciplined, and know where your red line is. Thanks, Bryce.
Thank you.